Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 1580 AM, The Big Talker. Thank you for joining me this afternoon. For those of you who don't know or are not familiar, Real Estate Radio is a program dedicated to building the Washington, D.C. Metro's housing and credit markets. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 AM, The Big Talker. Quick reminder, if you guys ever have any questions, concerns, whether it's real estate related, credit, finance, anything that you possibly have questions about, reach out to us at the off-air number. It's 877-245-2030. That's 877-245-2030. So we got a lot of great topics to cover today. There's a lot going on. We've had the primary debates going on with a lot of the Republican candidates that are trying to make their way to the top. We have a lot of information today on how appraisals are derailing home sales, and that's going to be coming up in the next 30 minutes. Also, Fannie Mae and Freddie Mac are growing uneasy with mortgage insurer troubles. And that's significant to you guys because that can really impact conventional mortgages moving forward. And lastly, we're going to cover how you can refinance your home without having to start over on a new 30-year mortgage term. Joining me on our panel today to discuss these issues and many more is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as what's on deck this week that can affect you and your real estate decisions. Louis, how you doing today, buddy?
All right, and yourself, Ryan?
I am doing well, sir. Thank you very much. You know, Louis, I wanted to start out. It was kind of interesting. I did a lot of reading and was watching different things this past weekend. And, you know, there's just a lot of stuff that's going on right now that really bothers me. The first thing that really stuck in my mind, I was watching one of the primary debates, was Newt Gingrich. They had asked him a question about housing and what he thought that they should do. And one of the things that he brought up, and I don't know where he even got this from, was he was saying, well, he thought that the reason why many of Fannie Mae, Freddie Mac, and banks were foreclosing is because it was smarter for them to do that because it was netting them more money. And I'm thinking in the back of my head, did he really just say that? Does he really think that by foreclosing, the bank is saving money versus doing a short sale or working out some sort of modification with the borrower? I mean, you're talking about a substantial difference. It could be, you know, with all the fees, attorney fees and everything, you're talking about an additional $50,000 to foreclose versus working out a short sale with the borrower.
Sure, but I don't think he was considering the option of short sale. That's probably what was behind his answer.
You think that he was saying that as an alternative, just not modifying somebody's loan? I hope so. Because when politicians start to throw out things like that, it's like, you know, if you're not familiar with the area, just don't answer the question. I mean, that's most of the time what they do anyway, right?
Well, right. What Herman Cain says is, I'm going to have advisors.
Yeah, exactly. And he's going to say that repeatedly over and over to make sure that you know that he's going to hire many advisors, right?
Exactly. Well, you know the president can't know everything, but
of course.
To Gingrich's defense, he is fairly learned on the issues more than most of the other candidates.
Well, that's what I thought as well, but it was just kind of one of those glaring things that stuck out to me, just because I'm like, you know, I would have think that, especially with the government taking conservatorship of Fannie Mae and Freddie Mac, that would be one of the things that they would have had nailed down.
Well, sure, but the problem with those debates are there's 9 people on the stage. You have 3 panelists trying to make a point, and there's really no follow-up. I mean, someone could have asked that question. I was thinking, well, how do short sales fit in? Then they go on to something else, and they talk about bombing Iran or something. So you don't really get an opportunity to have a discussion in a debate. Every candidate is up there looking like Ron Paul had, I think he had 90 seconds in an hour trying to get your soundbite in. And it's very difficult to have a real debate and understand whether the candidates even understand what they're talking about and give them a chance to kind of talk to each other. And you just don't see that in these debates. So I don't think they've had over half a dozen of them. You really don't learn much except how well they perform in that particular forum.
Yeah, and whether they can think on their feet. I mean, that's pretty much what it looks like to me. I mean, because you know what? Really, I mean, with the housing situation where it is now, they could have done a whole debate just on that. You know what I mean?
They haven't done that one. I think the one last, I guess it was Saturday night, was on foreign affairs.
Yeah, the one that was on
Commander-in-Chief, I think, is what the concept was.
Yeah, Commander-in-Chief. I believe the one that was on earlier in the week, I don't know, I want to say it was like Wednesday, was the one with CNBC with Kramer and all them. They were asking all of economic questions about the economy and what they were going to do for housing. And,
Right.
and that's the one that I watched. I watched a little bit of the one on Friday, but it just is kind of like, this is one of the biggest concerns that we have. Louis, you and I talk about this time after time, week after week, about housing and how it's such, it really is one of the main drivers of, employment. It's needed and necessary. And it's like, I think we just say we should just let it be and let it work itself out. But ultimately, the government, without them willing to just release mass amounts of foreclosures to the market, we can never really clear this inventory.
No, the problem is you can't have a free market in the housing because it's so intricately linked to all these government programs and Freddie Mac and Fannie Mae.
Yes.
So it's kind of a pipe dream to think, well, it'll all just work its way out. Unfortunately, the government's got its hands so far into it, it's going to have to do something.
Yeah, and I'm becoming more worried about that, exactly what you're talking about, moving forward, because they are so tied up into this that I think that they can only make things worse and not better.
They can only make things worse because the people that are in charge don't know what they're doing, and also when you give them bonuses for losing money, they think they're doing the right thing. I don't understand how they rationalize giving the Freddie Mac and Fannie Mae executives bonuses.
I don't either.
I mean, are they saying that the entities themselves did well? Well, that's not true. Are they saying they're performing a benefit to the public by operating these entities? Well, nothing's getting fixed. So how do you justify them getting paid?
I don't. I don't justify. I mean, I can't see where they should be. Now, granted, like once they would get back to bailing back the Treasury, the money that they borrowed from them, they can get back into a positive situation. Maybe it's warranted. But
well, sure. Then you can actually point to something that they did.
Right now, let's see. Right now, they owe the government-sponsored enterprises, which are Fannie Mae and Freddie Mac, they owe a combined $151.7 billion in bailouts to the Treasury Department right now.
And they keep coming back for more.
And, I just mentioned at the start of the show, and I'm just going to go ahead and jump into it now, but the GSEs, or Fannie Mae and Freddie Mac, are actually growing uneasy because a lot of the mortgage insurance companies that are out there are having big troubles. Now, for you guys out there that are trying to figure out, what mortgage insurance and private mortgage insurance companies are, if you take out a loan that's greater than 80% of what your home is valued at, or the sales price of your home that you're buying, you need what's called mortgage insurance or private mortgage insurance. These are private insurance companies that come in and insure the additional money above the 80% against the borrower actually foreclosing. So they pay an insurance premium to them. Well, what's been going on over the last, I'd say 6 months to a year is these insurance companies are having big time problems. The reason why? There's a lot more defaults taking place now than there was in the past. Well, that then affects Fannie Mae and Freddie Mac further because they're not able to recoup all the losses from the mortgage insurance companies because they don't have the money to pay them.
Well, isn't that exactly the situation that we had during the banking crisis, where AIG had backstopped a lot of these credit default swaps for Goldman Sachs and the other banks, and when they went south, the banks went to AIG, and AIG says, we can't pay it.
Absolutely. This is the same, and this is why I really want to bring this to the forefront, because this is something they're not talking about.
And then what happened was the government had to bail out AIG to make sure that Goldman Sachs got paid.
Yep.
As part of the bank bailout.
You're absolutely right.
In addition to the bank bailout.
Yep. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano. We're discussing Fannie Mae and Freddie Mac and the growing the uneasiness that they've had over the mortgage insurance companies' troubles. And I believe Fannie right now has more than $386 billion in unpaid principal that is covered by its insurers. Freddie Mac, the number is around $206.9 billion, and this is according to their filings. But the maximum amount that both of these firms could receive in actual potential loss recoveries is significantly less than that number. Fannie is reporting a maximum of somewhere around $92.1 billion in possible payouts, and Freddie Mac somewhere around $53.7. So this is nowhere near the amount that they need to recoup the money that they're saying was already insured.
So then what happens if...
Well, I can tell you what's going to happen. Treasury bailing them out all over again. Fed stepping in. So, I mean, this is just going to be a continuous bailout until... And that's why I believe Congress knows that. They know what's going on behind the scenes. And ultimately, that's why a lot of them are trying to say we need to figure out to just get rid of them or do something with them. But there's also the whole qualified residential mortgage. If you remember, that was the law that they want to put in place that would require borrowers to put down 20%. The reason why they're saying that is because they know that these issues exist with the mortgage insurance companies. And the only way around not having to deal with the mortgage insurance companies is to have a borrower put 20% down. Well, if you do that, I would say who's going to be the majority holder in mortgages? It's going to be FHA, because FHA only requires a 3.5% down payment. So you're going to take basically Fannie Mae and Freddie Mac, which are basically under government control now, and you're going to send all of those loans now into FHA, which is just another government program. So really, then it's just going to drive up the cost of those loans, and it's going to make it more difficult and harder for borrowers to actually obtain loans.
And if you think what happened was they drove up the housing prices through the easy credit and for the easy availability of mortgages, therefore causing them to have to come back down to normal levels. And now they have to bail them out because they drove the price up, and now they have to bail them out because the price went down. They're not insured.
Yep. Yeah. I mean, it's just really scary.
And there's your example. Why not to have the government involved in housing or take financial aid for school as well?
Yeah.
I mean, why do the students owe trillions of dollars? Because the price of education went up, not because the quality went up, not because they did anything more, just because they could charge more because of the availability of student loans.
I believe in one of the debates, Ron Paul was quoted as saying something like, they asked him, well, how do you expect them to pay for their education? And he said, the same way they pay for their cell phone bill. And what he's basically referring to is
competition.
The competition brings down the price of everything. And education over time has just gone through the roof because of the availability of these loans.
Well, they make it sound as if there is competition, people won't have access to products and services, when it's actually the opposite.
Correct.
When the government sponsors products and services, they just make it more expensive, and then people have to borrow money, and they guarantee the loans to buy something that's overvalued.
And I believe there's somewhat like $1 trillion worth of student loans outstanding.
Hey, and is the education really any better? Of course not.
No.
They didn't get smaller class sizes. They didn't improve the quality of the teaching. They just charged more every year in excess of inflation. I think college was going up 15-20% a year.
Right. Yep.
And now that the reason college used to be a good thing for the job market was you had an advantage over everyone else. But if everyone goes to college and everybody's indebted and no one has jobs, how are they going to pay back the loans?
Yeah.
Now, if the cost for the college wasn't so expensive, then paying off the loan wouldn't be the biggest of their challenges. Getting a job would, but when you have to get a job at a certain rate to pay back your student loan, you're kind of in a bad situation, and that ties into housing. If you have a student loan and you don't have a job, good luck buying a house.
Yeah, Matt, you bring up a good point, because I just actually had a listener call the other day and was asking about. She was basically just got out of dental school and has gone into a practice with many other dentists. And probably, let's just say she has a whole mortgage worth of school and loans that she's taken out for her dental school. I don't even know. Let's just say it's over $200,000+. Well, don't you think that's like a mortgage payment that's going to affect tremendously the amount that you qualify for? Of course it is. And the only way, because I had to research this in depth. The only way that you can get around not counting that payment against you, and I hope everybody's listening because a lot of people have student loans out there. The only way that you can get around not having to count that payment is if the loan is deferred for 1 year from the time that you would actually close on the property. Okay? Now, that's not 1 year from the time you start looking. It's from 1 year of that closing date. And it has to be in writing from the student loan company, which most of the time, good luck getting that. And a lot of the ones that are there, they'll allow you to defer them, but all you're doing is just adding a ridiculous amount of interest onto the backside of those loans. Ultimately, you're going to have to pay them anyway.
But, Ryan, even if you can get them deferred, don't you still have the issue that you still have debt outstanding?
Yes.
And, to take on more debt when you don't really have a job.
But this goes back to the whole thing. Yeah, the United States is basically pushing people, get as much education as you can. And they get these bills. How are they going to ever pay them back?
Well, it's pushing really that the economy is based on debt financing, that the housing market needs to be in good shape, but the way to make the housing market in good shape is by making available financing. And basically you have a consumption society where people buy stuff or take out debt to buy stuff, and I think that's 70% of the GDP. Yeah. And that's a real problem. And then when interest rates rise, it's harder for people to buy stuff. And the whole thing starts to collapse. It's only being held up artificially by the low interest rates when the interest rates need to go higher and people need to stop borrowing money.
Yeah, when we come back, we're going to jump into interest rates and how you can refinance your home without having to start over for 30 years. You're listening to Real Estate Radio. Be right back.